A new wave of options on spot Bitcoin ETFs is being hailed as a game changer for Bitcoin. And they're not even trading yet. And fans say they will be wild and unbelievably fantastic. But don't they know that crypto options have been around for years now? They haven't been game-changing so far, so what's all the sudden excitement about?
I'm so excited!
To find out, we're going boldly where, apparently, few crypto bros have been before, deep into the world of options. You'll learn how options work, their prospects for adoption in crypto, and why this time they might actually send BTC through the roof. This is a video you don't want to miss. Recently, the SEC approved options for BlackRock's IBIT Spot Bitcoin ETF. There are a few more hurdles for Larry and the gang to clear before these things can start trading, but it appears to be a done deal at this point. And like with the ETFs themselves, BlackRock's IBIT options are likely to be followed by a wave of competitor equivalents. And this has got a lot of people extremely excited, and we'll soon find out why. But first, if you're not familiar with options, let's get you up to speed. Options are a financial derivative. Like futures and perps, you are buying and selling a contract and not the underlying asset itself. Options contracts give the buyer the right, but not the obligation, to buy or sell an asset, in this case BTC, at a predetermined price and date in the future. An option to buy is called a call, and an option to sell is called a put. On the leading crypto options platforms, a typical call option contract will control 1 Bitcoin. But the price of the contract, called the premium, is far less. And this makes options a highly leveraged instrument. Let's use an example. Bitcoin is trading around 65,000 at the time of making this video. Now, if I buy 5,000 worth of Bitcoin today and BTC increases to 75,000, then I make a profit of around 770 or 15%. Alternatively, I can buy a $5,000 BTC call option that expires, say, 1 month from now with a strike price of 65,000. The strike price is the price that I want to pay when the contract expires. 1 month passes and the market price of BTC has risen to 75k. Since my call option controls 1 BTC, it now has an intrinsic value of $10,000. In options parlance, we'd say I am $10,000 in the money. And since the option cost me $5,000, I made a $5,000 profit, or 100%. Put options are simply the reverse situation. If I think that BTC's price is going to fall, I can buy a put option to sell it for a more favorable price and profit. So if BTC trades at 65k today and I expect it to be at 55k a month from now, I could buy a $5,000 put option that expires in 1 month with a strike price of 65,000. If my prediction works out and I get to sell 1 BTC for 65k when the market price is 55k, then I've made a $5,000 profit. Because of the leverage involved, options can be much more lucrative than just hodling. Of course, when the expiration date rolls around, the price of BTC could be below your call option premium or above your put option price. This would make your option worthless and you just lost $5,000. In other words, you were out of the money and your option expired worthless. And this is pretty bad, but it could actually be less risky than perpetual futures trading that is so popular in crypto. And that's because if I take my $5,000 and use 13 times leverage on perps to control a position of 1 BTC, it's possible to lose much more than $5,000 if the market turns against me. Also, with options, there is no liquidation, so the worst that can happen is that I am left holding a bag of a useless contract.
Hey man, hey, what do you do for a living?
Me? I'm a crypto YouTuber. Yeah, it's pretty fun job actually. See ya.
What about you? What do you do for a living?
Oh, me, man, I checked the Coinbureau deals page. It's got sign-up bonuses of up to $100,000 and trading fee discounts, but I mean huge trading fee discounts, and exclusive altcoin alpha in their subscription service. Check it out. Now, let's take a moment to consider the other side of the equation. We just looked at buying, call, and put options, but you could also be the writer of the contract, meaning that you are the one selling a call or a put. Remember, the buyer pays for the right, but not the obligation to buy at the price and date in the contract. The writer, on the other hand, is collecting a payment in exchange for their obligation to sell or buy an asset at the price and date stipulated in the contract. In this case, you are specifically making a bet that the contract will become worthless. If you think that BTC is going to be $75,000 next month, you do not want to sell a call option that expires in a month with a strike price below $75,000, as this would force you to sell one BTC for less than the market price. Sure, you collected a premium for the sale of the option contract, but what if BTC goes to 90,000 and you have to sell it for 70,000? Played yourself a big time. You either have to sell your one BTC for much less than it's worth, or if you don't even have one BTC, you have to buy one BTC for 90,000 and immediately sell it at a $20,000 loss. And this brings me to the main kinds of option writing strategies: covered calls and cash secured puts. A covered call is when you own the underlying asset. So in our scenario, you own one BTC. You would sell covered calls to generate income from your holdings. In Bitcoin's case, this means you can generate a kind of yield on your BTC. As Bitcoin has no staking, this yield is a very attractive proposition to some market participants. Plus, if you bought your BTC a long time ago at a lower price, your risk may be limited to missing out on just a bit of gains, because if you have to sell your BTC when the call option expires, you may still be selling at a huge profit. A cash-secured put is a similar premise. Here, you're holding enough cash to buy the underlying asset at the strike price. And this is a way to generate yield from sitting on a pile of cash. Your ideal scenario is for BTC to stay above the strike price, because then the option is worthless at expiry and you just collected a premium payment for doing nothing. Alternatively, you can sell naked calls or puts. And this means you are obliging yourself to sell an asset you don't even have, or buy an asset without having the cash to do so. For example, if I sell a naked call option and the buyer ultimately exercises their right to buy, then I have to rush to the market to buy BTC and then sell it immediately at a loss. This is a little like bluffing, because when someone calls your bluff or unexpectedly exercises an option that you sold them, you might find yourself in a very tight spot. As you might expect, options entail significant counterparty risk. A default can occur when the market turns against the writer of the option contract and they become unable to meet their obligation. With a highly volatile asset like BTC, the risk is amplified. In the US, options buyers are protected by the Options Clearing Corporation, or OCC, which oversees the market. The OCC mitigates the risk of default by closely monitoring positions and requiring brokers to enforce strict margin requirements, including daily margin calls. If a default does happen, the OCC steps in and guarantees the contract is fulfilled. Until now, there was no options market for BTC in the US backed by the OCC. And this means that pre-existing markets, like the options on the BTC futures trading on the CME, were unregulated and subject to significant counterparty risk. And this made them less appealing in general and basically untouchable for many institutional investors. If the name Deribit means anything to you, you'll know that there is also a crypto-native options market. And Deribit has a market share of something like 80%, making it more or less the only show in town for people who want to buy and sell options using BTC and ETH on a crypto exchange. As an unregulated offshore exchange, Deribit is not supposed to be available to US users. It's likely that determined Americans may have found their way around this restriction, but the fact is that crypto options has been a kind of a niche interest. And this can be seen in the trading volume for BTC options compared to spot and perps. The average monthly volume for BTC options on crypto exchanges in Q1 was 52.56 billion, so roughly 150 billion in total. Now consider that the trading volume for BTC futures was over 1.4 trillion on BitGet during the same period. A single BTC futures market on a single crypto exchange was almost 10 times larger than all BTC options markets combined. Let that sink in. We think there are a few reasons why options have not really caught on in crypto. Firstly, the lack of a regulated market in the US limits the amount of capital that can flow into the crypto options market. And secondly, for market participants seeking leverage, options on crypto exchanges are a more complicated and much less exciting proposition than perps, which make up the vast majority of all crypto trading volume. For risk-loving degens, perps and crypto, they're a match made in heaven. You bet on whether the price of a highly volatile asset is going to go up or down, slide the leverage up to maximum, and off you go, rinse and repeat until your account balance is zero. It's totally linear, and since there is no expiration date, the fact that you are trading financial contracts rather than crypto is entirely abstracted away. In other words, perps are very easy to understand and use. Options, by comparison, are a much more sophisticated game. You have to make decisions on multiple factors, including the strike price relative to the price of the underlying asset, the remaining duration of the option contract, implied volatility, and also the premium or the price of the option contract. Premiums will change constantly depending on a complex matrix of variables. If you've ever heard the expression, "it's all Greek to me," well, it was probably coined by someone confused by options trading, because 5 of these variables are known as the Greeks: delta, gamma, theta, vega, and rho. Without getting too deep into it, the Greeks express how the premiums are affected by the price and volatility of the underlying asset, and of course the passage of time. It's quite a lot to take in, so perhaps you can imagine how crypto bros faced with the choice between max long in dog coins and studying the nuances of options have tended to go for the former. Now, if you're familiar with the world of meme stocks like GME and AMC, you'll probably know that options are actually quite popular with TradFi retail investors. But you have to understand that they don't have the same access to leverage that we do. They don't even have perps. US stocks do have a futures market, but these are subject to factors like dividends and interest rates, and the contracts need periodic settlement to reflect these adjustments. More importantly, retail investors' access to leverage is much more constrained. They don't let you 100x long or short anything. It's practically a desert out there. Options are about the most excitement they can get. It's not like over here in the fast lane. Anyway, now that IBIT options are coming, social media is suddenly all abuzz about how this is some kind of a game changer for crypto. So why is that? To understand why, we will refer to a post made by Jeff Park, head of alpha strategy at the crypto index fund manager and ETF provider Bitwise. Park's excited commentary went about as viral as it can get on options Twitter. It's been viewed more than 1 million times at the time of making this video. And Park says that Bitcoin's unique properties and the nature of the regulated options market are a powerful combination. Let's unpack that. Firstly, there has never been an OCC-protected regulated market for options on BTC in the US. Park suggests that the risk of counterparty default has deterred adoption of the existing unregulated markets like Deribit and CME futures. But now, thanks to the protection of the OCC, there will be nothing to stop retail and institutional investors flooding into the options market. According to another commentator, the Bitcoin maxi Fred Kruger, the new regulated market for options could even supplant perps to some extent. And this would be an extraordinary change because, as we saw earlier, the vast majority of volume traded in crypto is in perps. Kruger and Park expect these options to be hugely popular because A, people love leverage, and B, compared to perps, options are a superior way of making speculative leveraged bets. They do have a point because perp traders live in constant fear of being targeted for liquidation by market manipulators with enough capital and cunning to cause prices to wick violently up or down. With options, you don't have this problem. You pay an upfront premium for an option, and the worst that can happen is that it becomes worthless on expiry. You can't lose more than the premium, and despite options being a highly leveraged instrument, there is no being liquidated. It's an entirely different form of leverage, and one that should appeal to market participants who want to take on risk, but don't want to deal with the high-octane perils of perp trading. Plus, there is the time horizon factor. Options serve market participants who want to make leveraged bets on the medium to long-term market moves, say a week to a few months in the future. Then again, we're no longer talking about the new regulated market for options on IBIT here. This is just an argument about the nature of the options. And if options are by nature so superior to perps, you have to wonder again why existing crypto options have seen so little adoption by the crypto traders. Anyways, this is just the basic pitch for options in their newly regulated market in the US. Now, why does Park say that the combination of options and Bitcoin specifically is such a powerful one? This is related to the role of volatility in options trading and BTC's unique volatility characteristics. Firstly, the more volatile an asset is, the more expensive premiums tend to be. More volatility means the chance of making a big profit or loss are greater, so there is more demand for protection in the form of puts or the ability to speculate with calls. Unlike most equities and indices, when BTC's spot price increases, so does volatility. As the price of BTC rises, premiums become increasingly sensitive to changes in BTC's price. The result is that the price of the premiums can start to increase faster than the price of BTC itself. All of this is a very big deal for market makers. The higher BTC goes, the more holders of call options will be in the money and therefore likely to exercise their option to buy. The counterparty here is the market maker who will be facing the losses. To hedge their own position, market makers are forced to buy BTC. If this happens on a large enough scale, buying pressure from market makers will push up the price of BTC. And voila, you have a positive feedback loop. And this is called a gamma squeeze, or more precisely, a negative Vanna gamma squeeze. Don't ask. Park puts it in simpler terms. Quote, Bitcoin's case becomes explosively recursive. More upside leads to even more upside as dealers are forced to keep buying at higher prices. A negative Vanna gamma squeeze acts like a refueling rocket. Well, I do like the sound of that. Say, did you know that options on spot Ethereum ETFs could come as soon as November? Probably nothing. Recent history showed us what happens when a group of savvy retail investors spot the possibility for a gamma squeeze and manage to make it happen. I'm talking about the case of GameStop, whose shares rose from around $4 to more than $500 in an historic gamma squeeze in January 2021. And this is folklore for retail investors. So when Jeff Park dropped the magic words gamma squeeze in relation to BTC, you had better believe eyes started popping. And Park adds a cherry on top to this proposition by reminding us that BTC's max supply is of course capped, and that it trades 24/7, 365, not only on centralized exchanges, but also on the decentralized market on-chain. This is important because it means that there is no Bitcoin corporation who can dampen a gamma squeeze by issuing more BTC and diluting the supply. Plus, no matter how hot the market gets, no exchange operator or regulator will be able to shut it down in any sense. If you are familiar with the chronicles of GameStop, you'll know that several brokerage platforms, including Robinhood, restricted trading on its stock during the gamma squeeze. A few months later, GameStop increased the supply of its shares, thereby diluting their value. As neither of these things can happen with BTC, Park concludes that IBIT options are going to be, quote, unbelievably fantastic. Kruger said, quote, it's going to be wild. There are a few more regulatory hurdles for the new options to clear before they can begin trading, but it is likely that options on IBIT will debut alongside options on other competing BTC ETFs too, which are bound to materialize. Plus, BlackRock is apparently already cooking up plans for options on its Ethereum ETF. If the thesis outlined by Jeff Park comes to pass, this could be a driver for some of the most bonkers BTC price action seen this decade. If it's indeed true that the regulatory status quo in the US is what's prevented existing BTC options seeing mass adoption, then the new generation of regulated options markets might be everything they're cracked up to be. On the other hand, the fact that BTC options have existed in different forms for years now makes us a little cautious to believe all the hype. Unbelievably fantastic? Maybe, but we'll believe it when we see it. After all, the options on the spot Bitcoin ETFs still need to be approved by the OCC and the CFTC before they can list. It's unclear how long this process will take, as there's no fixed timeline for approval in either case. With some luck, it'll come sooner rather than later. In the interim, don't be surprised if speculators start pointing to the upcoming options as the reason for any BTC rally. Right, that's enough about options for one video. Let us know what you think about the new options hype in the comments down below. And if you learned something new, consider exercising your option to smash the like, subscribe, and notification bell. You'll give us a boost and make sure you never miss another upload. As always, thank you very much for watching, and I'll see you the next time. This is Nick, signing off.